This is our Forex blog for February 16th, 2012. And like most days, you want to buy the strong ones versus the weak. You can see the dollar and the yen started the day off strong, even though their longer term trend is obviously down. You always want to focus mainly on what the real-time momentum is. If you see a lot of strength followed by less weakness, and you see strength for 2 or 3 hours followed by half an hour of weakness, usually that strength will continue. If currencies are up or down too much, like the dollar and yen have been, a lot of times you have counter trend days. So it's always important to look at a daily chart. If you see, the euro-dollar pair up 3, 4, 5 days in a row, that means the dollar's been weak. If the pound dollar is also up, dollar Swiss, dollar CAD are down, then you can, most of the time expect a counter trend day. And if you see some real-time strength in the dollar, even though the longer-term trend's down, you want to trade it. And you obviously, between the two pairs, most people trade the dollar and the yen. If you see one currency that has, a little bit more strength than the other, followed by the pullbacks, have less weakness, usually it's more likely to continue. Myself personally, if I had very similar patterns in both, the yen looks better, but the daily, weekly, monthly trend are weaker to the downside, I would choose the one that has the least amount of weakness longer term. So basically, the dollar and the yen were strong last night. Let's scroll this back. I just brought this up today. Normally, this keeps the daily, weekly, monthly trends underneath, and it keeps up to date bar by bar. Coming up to today, one of the weaker ones was in New Zealand. And so last night, you would be looking for New Zealand dollar sells. Coming up to midnight, notice, this is once it breaks from above to below the hourly moving average, you have a trend down. These are my Fibonacci profit target levels that I pretty much spend about 30 or 40 minutes a night on, and I usually do it right around 6 or 7 o'clock at night, and these then show up at midnight. They reflect the next day. These are very high probability maximum lows of the day. It's based on not only Fibonacci analysis, but also our statistical range tool. I use a slightly different method of Fibonacci analysis than probably anyone else does, based on our statistical tools and how I've been trading for the last 6 years in Forex. So especially since this has a weekly and monthly trend up, this was likely to be the maximum low. So you're looking for some sells, sell here, but once it gets down to that low, you don't want to sell it anymore. The pound, very strong last night, and once the yen started going weak like this, it's a no-brainer looking for a pound yen buy. And you can see that it telegraphed this move even earlier. Notice extreme strength right here, and then about 15 or 20 minutes is of a sideways move. This is kind of a little flag pattern. Flag patterns are wonderful when you spot them like this, and a lot of times you can spot them on range charts. You would go long right there and use the trailing stop. It got you out right here at 49. And at 06, you made 43 pips on that move. And most of the time, price does not go and stay above the upper containment bands. Maybe once every 5 to 10 days, you'll see currencies go above the 2.0 white containment band and continue. Most days, that does not happen. They hit the lower bands, and you get a bounce off of them, as you can see yesterday. Hit the upper bands, bounce off of it. It's very rare to go and stay above the upper containment bands. If you're on one of those trend days like this, you can buy above the upper containment bands, but don't really pay up more than 25 pips outside these bands. So here's another flag pattern. You might have taken that trade and used your trailing stop to get you out, and it pretty much caught the entire move. This was my second Fibonacci area, and the likely max high of the day, and it's pretty much stayed there for the last few hours. Later in the day, the Australian resumed its daily, weekly, and monthly trend. And so you could have also done the same thing with your Australian. Buy the strong Australian versus the weak yen. And this one, again, broke from underneath above the hourly. And one of the trades that I take, if I know a currency is super strong, longer term, weekly, monthly trend, if I see a currency go underneath the hourly, just a few measly pips, less than 25 pips, and then come up to it, find resistance, which proves some people were selling there. When it goes back above the previous day's low right here, it's a pretty high probability place to go long at 72. You're out of this trade maybe at 93, picked up 20 pips. You might have bought this little pullback here, made a little bit of money, bought this and made a little bit of money, bought this and lost, and then bought this at 06 and out at 37 for a 31 pip win. You're always going to have losing trades no matter what system you trade. The key is to make them very small. A lot of times when you get into a trade, you can see the initial stop. As soon as the price starts going up, the stop very quickly goes to break even. So a lot of times your loss is not what the initial stop is. You use the initial stop, which most times is 10 or 12 pips, to determine how many lots you trade. We recommend 1 or 2% risk per trade, and that means once you know how many pips you're risking, you can decide how many lots to trade. But keep in mind that, again, most of the time you're trading the strongest pairs up and selling the weakest pairs down. Therefore, there's usually enough momentum to cause some kind of movement, whether it's 3 to 10 or 12 pips. That tightens your stop, and a lot of times trades are break even like this. If you bought right here, it did go up a little bit and came down and stopped you out at 06. It's a small 6-pip win, versus a loss. That you always want to. That's one of the reasons why we have the currency meter. It increases your odds, in my opinion.